Welcome to the Deep Dive. We're here to take your sources, your curiosity, and really dig into what matters.
Yeah, get right to the heart of it.
So, you wanted to understand wealth building,
Okay.
and you pointed us towards Richard Templar's The Rules of Wealth.
A popular one, yeah.
And our mission today is basically to pull out those key ideas, maybe some surprising insights, the stuff you can actually use, without all the dense finance jargon.
Exactly. And we're not just like ticking off a list of money tips. What's really interesting about Templar's approach, I think, is his focus on the bigger picture.
Oh, yeah. How so?
Well, he asks, what does wealth actually buy you? And often it boils down to freedom, right? More control over your time, maybe deeper connections, being able to support causes you believe in.
So a richer life, not just a fatter wallet.
That's the idea, a richer life.
Okay, so he kicks things off with this point that really struck me. He says the wealthy aren't some monolithic group. They're all different.
Right, no single mold.
And the very first step for you, the listener, is to figure out, really nail down what wealth means to you personally. Forget the neighbors for a second.
That's so fundamental. The book literally asks, if we don't have a definition, how can we monitor or judge success? It's not about just picking a number.
Right.
What does success look like in your life? Is it passive income,
Mhm.
travel, security to take career risks, whatever it is for you?
Okay, so define it first.
Define it first. And then, Templar argues, you need clear objectives and, importantly, a realistic timeline to actually get there. He says, you will want to know in advance what rich means to you, how you intend getting there, and how long you expect it to take.
It gives you that structure, that roadmap you mentioned needing.
Exactly. Otherwise, you're just sort of drifting.
It's like trying to hit a target you can't even see, right?
Unracely.
Okay, so you got your target. Then Templar pivots a bit into the mindset stuff. One rule that jumped out was this idea of keeping your financial goals quiet, at least initially.
Yeah, keep it under your hat. It's interesting the psychology he suggests behind it.
Tell me more.
Well, he reckons talking about big ambitions too early can sometimes, attract negativity or even jealousy, maybe subconsciously.
Like people feel judged or something?
Kind of, or they just project their own doubts onto you. So it's about protecting that initial spark, that momentum from outside static.
And it's not just about others, is it? He also pushes you to really look at your own reasons. Like, why do you actually want more money?
Yeah, is it just more for more's sake? Or is it tied to something deeper? Supporting family, a cause, personal freedom?
What's the point?
Exactly. He asks directly, so what's your excuse? What do you want money for? Getting clear on that why is, well, it's powerful fuel, keeps you going when it gets tough.
He even says write it down, right?
Yeah, make it concrete. Then you can check if what you're doing day to day actually lines up with those bigger goals.
Okay, another mindset shift he suggests is work as if you didn't need the money, which sounds kind of backward for most people.
It does sound counterintuitive, but the idea is about shifting the power dynamic.
That's so.
If people sense you're desperate for that paycheck, maybe they take advantage. But if you approach work because you're genuinely interested, contributing something valuable, not just out of sheer necessity,
It changes things.
it changes your whole stance. You're more confident. You're maybe more willing to walk away from a bad deal. It's empowering.
Okay, that makes sense. So, definition, objectives, mindset, check. Now, let's get into the nitty-gritty, the actual strategy.
Right, the practical stuff.
One of the first ones he lays out is calculate the net return. This isn't just the big flashy number you see first, is it?
Oh, absolutely not. That's crucial. He uses a great example with rental properties.
Yeah.
You see the monthly rent check and think, wow, great return. But then you have to subtract, well, everything else. The mortgage, property taxes, insurance, any management fees, times it's empty, income tax on the rent.
Whoa, okay. Lot more to it.
A lot more. The net return, what's actually left in your pocket, can look very, very different. It's about seeing the real profit, not just the income.
Right. And before you even get to investing, Templar hits this really basic thing. You got to stop the leaks, live within your means, figure out where the money's actually going.
Absolutely fundamental. As he says, before you can control your finances, you have to stop the leaks. It means really understanding your spending.
Like actually track it.
Yeah, he suggests tracking every penny for a week, maybe a month, even the small stuff. Coffee, snacks.
You'd be surprised,
You
probably.
probably would. Those little leaks add up fast. Once you see them, you can make actual choices about where your money goes.
He also takes a slightly, maybe controversial look at insurance, saying insurance pays someone, and odds are it's not you.
Yeah, he's not saying never get insurance, but he wants you to think critically about it.
Okay.
His point is, insurance companies exist to make a profit. That means, statistically, over time, they have to take in more in premiums than they pay out in claims.
Right. Otherwise, it wouldn't be in business.
Exactly. So averaged out, you're likely to pay more in than you get back. He suggests really looking at the risks you're insuring against. Could you maybe handle some smaller risks yourself by just having savings? Self-insuring, essentially.
Interesting perspective.
Yeah.
Now, here's one that sounds a bit edgy. Speculate to accumulate.
Yeah.
But he's quick to say this isn't gambling.
Very quick to clarify. No, it's not about throwing money at random things.
So what is it about?
Think of it like an actor who suddenly becomes famous. It looks overnight, but they spent years doing small plays, honing their craft, taking calculated steps. Building wealth often involves taking calculated risks.
Okay, calculated risks.
Putting money where it has potential to grow, but doing it thoughtfully. Researching, understanding the downsides, making informed decisions. It's the total opposite of just, hoping your lottery numbers come up.
Gotcha. He also talks about time being on your side with start saving young. And even if, maybe for some of us listening, that ship has sailed,
Yeah.
he says it's crucial to teach kids this, and that your strategies need to change as you age anyway.
Totally. Your goals in your 20s, maybe paying off debt, starting a career, are going to be way different than in your 50s when you're looking towards retirement, right?
Makes sense. You adapt.
You have to adapt your financial plan to fit where you are in life.
One really interesting practical skill he focuses on is negotiation. Become a good negotiator. He tells that story about the guy who traded a paperclip for a house.
Cal McDonald, yeah, that story is amazing. It really shows the power of creative deal-making.
And Templar says this isn't just for big business deals.
Not at all. It's a life skill. Negotiating salary, getting a better price on something. It applies everywhere.
So what are the keys?
He lists a few. Know your bottom line, your absolute minimum. Know your ideal outcome. Aim for win-win so both sides feel good. Be flexible. And crucially, do your homework. Be prepared.
Okay, shifting gears a bit, avoiding the big mistakes. Templar is super clear on this one. Don't borrow money unless you really, really have to. He sounds quite strong about it.
He really is. He sees debt, especially high-interest debt, as just a massive drag on building wealth. All that interest you're paying.
It works against you.
Totally. He basically says, avoid borrowing from anyone if you can possibly help it. Banks, credit cards, even friends or family sometimes. It just adds cost and stress.
But he does admit sometimes it's necessary. And then he says, consider consolidating debts.
Yeah, strategically. If
Yeah.
you've got lots of different debts, maybe at high interest rates, rolling them into one loan with a lower rate can save you money and make things simpler.
But it's not a magic fix.
No, definitely not. It has to be part of a plan to get back on track, not an excuse to just borrow more. His main message is loud and clear: get out of debt. It just weighs you down.
Another interesting avoidance rule is play your own brand.
Yeah.
What's that about? It sounds a bit corporate, maybe.
It's not really about being fake, though. It's more about recognizing that how you present yourself matters. Your reputation, your integrity, how you communicate.
Oh, okay. How people see you.
Exactly. Does it project professionalism, trustworthiness? It influences whether people want to do business with you or trust you. It's about being aware of that image online and off, and making sure it's authentically you, but also professional.
Right. Then there are the warnings about things that seem too easy. Like, don't answer ads that promise get-rich-quick schemes.
It won't be you who gets rich quick. Oh, yeah, he's very direct there.
And he dismisses the whole idea of financial secrets, right? There are no secrets.
He's deeply skeptical of anything promising instant, effortless riches. Because, let's be honest, the only ones usually getting rich are the people selling the scheme.
So what's the alternative?
Real wealth building, he insists, it's about consistent effort, it's making smart choices over time, understanding the fundamentals, no magic wand. He basically says, use your head. Logic, research, not just emotion or hype.
And once you have used your head and made a plan, his advice is kind of simple. Don't fiddle.
Yeah. Resist that urge to constantly tweak your investments based on every news headline or market wobble.
Why not? Isn't it good to be responsive?
He compares wealth building to patiently stalking prey. It needs a steady, long-term view. Chopping and changing all the time, reacting to short-term noise, often just racks up costs, and you miss out on long-term growth. Make a good plan, then generally stick with it.
Okay. He also throws out a few quick ones. Check the small print. Always good advice. Have lots of hats, meaning diversify your income. Don't rely on just one source.
Smart risk management, yeah.
Also, control spending impulses. Easier said than done sometimes. And I don't believe you can always win, especially against like casinos or big institutions designed to profit.
Right, a dose of realism. Diversification spreads risk, controlling spending frees up capital, and knowing when the odds are stacked against you saves you money. It's all part of that sensible foundation.
Okay, so moving towards maintaining wealth and maybe sharing it, Templar says carry out a finance health check regularly, like a checkup for your money.
Exactly. Make it a regular thing, maybe monthly, maybe quarterly. Just review everything. Income, outgoings, investments, debts.
Catch problems early.
Catch problems early, make adjustments, stay on track. And alongside that, he strongly suggests get some money mentors.
People who've been there, done that.
Yeah, people who've achieved financial success, whose judgment you trust, and crucially, who don't have a vested interest in selling you something. Just good, independent advice.
He also makes room for intuition. Interestingly, play your hunches.
Yeah, he suggests that sometimes your gut feeling, especially when it's backed up by knowledge and experience, can be valuable. But it's not just a hunch, it's informed intuition.
And know your limits.
Oh,
Get someone to do the stuff you can't. Delegate.
absolutely. Focus on what you're good at. Recognizing you need help with, say, complex accounting or legal stuff, that's actually a sign of financial maturity.
He also talks about needing to know when to get out of an investment, timing the exit.
Crucial. And related to that, understanding basic financial statements. He specifically mentions know why you should be able to read a balance sheet and how.
Okay, balance sheet. Break that down quickly.
Sure. Think of it like a snapshot. At one specific moment, what do you own, your assets, and what do you owe, your liabilities? Seeing that gives you the big picture of your financial health, not just the flow of money in and out.
Got it. He also slips in some practical tips like shop for quality, suggesting it's better value long-term than just cheap stuff.
Often true, yeah. Lasts longer, works better.
And again, check the small print in contracts. Seems obvious, but easily missed. Plus, the need for a contingency fund, money set aside for emergencies.
That rainy day fund, it's your safety net. So when life throws a curveball job loss, unexpected bill, you don't have to panic or go into debt. It's proactive, long-term thinking.
Now, when it comes to sharing, or maybe not sharing, lending money, he's very firm. Never lend money to friends or family unless you are prepared to write it off.
Oof, yeah, that's a tough one, but often true. The potential damage to the relationship, it can be huge, often outweighs any financial aspect.
So what's the alternative if you want to help? He mentions equity. Don't lend, take equities.
Right. If it's for, say, a friend's business venture, instead of a loan they might struggle to repay, maybe consider taking a small ownership stake. Treat it like an investment. It sets clearer expectations, potentially avoids resentment later.
And then there's the idea of enough, knowing when to stop accumulating and thinking about how to use your wealth wisely.
Yeah, what's the point of it all? The real value isn't just the number, it's what you do with it, how you use it, how you share it.
He hits that home with, you really, really can't take it with you. A bit blunt, but true.
It makes you think about impact, legacy, the purpose beyond just having more.
And practically, he advises learn how to say no to financial requests, politely but firmly. And once you've got it, don't flaunt it. Keep it low-key.
Humility and discretion. He even throws in a joke about pacts with the devil, just reinforcing there are no magical shortcuts.
Right. It's all about that sensible, mature approach.
Exactly. Recognizing wealth's limits and the importance of generosity and, well, not being flashy about it.
Okay, finally, he wraps up with a section on the rules of other people's wealth. Starts with don't judge and don't envy it.
So important, because you rarely, if ever, know the full story behind someone else's finances. Envy is just corrosive, and judging doesn't help anyone.
And he reminds us, other people's money belongs to them.
Full stop. They can do whatever they want with it, including they can give it all away if they like, even potential inheritance.
Which leads to managing expectations, right?
Definitely. It ties into managing your own expectations about what you might receive from others. They have total control over their own assets.
He also touches on family dynamics. Blood comes before money, relationships first, and your children owe you nothing.
Yeah. Setting realistic expectations within families, valuing the relationship above potential financial gain.
And he encourages open communication. Don't make money taboo. Talk about it.
Healthy communication can prevent so many misunderstandings and resentments down the line.
And finally, a reassuring one. If they give it to you, it's yours. Accept gifts graciously. no strings attached.
Yeah, it provides a really healthy frame for thinking about money in that wider social family context. It's about respect, understanding, clear communication.
Okay, so wrapping up this deep dive into the rules of wealth, the big takeaway seems to be, well, that wealth building isn't just one thing. It's practical steps, sure, but also mindset and really understanding what it means for you.
Absolutely. Templar's rules, they give you a framework, a guide for making smarter choices, moving towards, a more prosperous future, however you define that.
It really seems to boil down to defining your goals, being disciplined, and applying these principles consistently.
That's the core of it. Long-term consistency over short-term flashes.
So that leads us to our final thought for you, the listener.
Mm.
As you've heard all these rules, maybe pause and think. Which one or two really jumped out, like really resonated with where you are right now?
Yeah.
How could focusing on just those, maybe implementing one or two, actually create a significant shift for you? Maybe start by revisiting that personal definition of wealth. What's your first step towards your objective?
Some good food for thought there. Thank you for joining us on this deep dive. We really hope exploring the rules of wealth has sparked some valuable insights for you.